Take a look at Aswath Damodaran's textbook, Investment Valuation. In modern corporate finance, this text serves as the definitive manual for pricing assets. Yet, despite the dense formulas filling its pages, the author notes that the practice is often haunted by Oscar Wilde's definition of a cynic, a person who knows the price of everything, but the value of nothing. There is a widespread belief across the industry that because valuation relies heavily on quantitative models, the resulting numbers are completely objective. But a formula cannot generate truth on its own. Mathematical precision simply masks the highly subjective human assumptions fed into the variables. In modern, high-velocity financial markets, treating those subjective inputs as hard facts inevitably leads to rapid capital destruction. True valuation is an exercise in structural architecture. It requires the qualitative skill of matching an asset's unique characteristics to one of three highly specific mathematical frameworks. If you select the wrong model for the asset in front of you, the accuracy of your arithmetic is irrelevant. The first framework is discounted cash flow, or DCF. This is the primary tool analysts use to estimate an asset's intrinsic value. This timeline visualizes a DCF. It takes future cash flows and pulls them backward to today, shrinking them by a discount rate to calculate present value. For firm valuation, you discount cash flows for both debt and equity. Alternatively, in equity valuation, you strip away debt entirely, discounting the remaining cash flows strictly to equity investors. But the DCF model has a fatal limitation. It operates almost entirely on predictability. If you apply this framework to a young startup, a highly distressed firm, or a company currently operating with negative earnings, the formula breaks down because the future cash flows are too erratic to map. Forcing early-stage or highly volatile assets through a DCF model produces a dangerous illusion of precision. When intrinsic certainty fails, analysts turn to the second framework, relative valuation. This is how the vast majority of real estate and public equities are actually priced in the real world. Here, you determine an asset's value by standardizing the current market prices of similar assets using a shared metric, like a price-to-earnings multiple. This scatter plot demonstrates the bludgeon view, taking a crude average of sector multiples and blindly applying it. Instead, rigorous valuation requires identifying specific underlying variables, like growth potential and default risk. By actively stripping away mismatched firms, you isolate a highly refined cluster of peers sharing the exact same financial profile. A multiple offers zero analytical value if the selected peer group does not strictly align with the target asset. Next, we reach the edge cases. Consider unproven patents or tracts of undeveloped land with undiscovered oil reserves. These assets generate exactly zero cash flow today, yet the market prices them highly. Traditional models value these assets at zero. To accurately price them, you have to use the third framework, contingent claim valuation, which utilizes option pricing theory. This graph illustrates an option. The flat baseline shows your downside risk is strictly bounded, while the line angling sharply upward shows theoretically infinite potential upside. In corporate finance, these are real options. They represent management choices, the option to delay an investment, expand a successful project, or quickly abandon a distressed firm. The DCF framework structurally ignores the value of time, and it ignores the flexibility of human managers to pivot their operations when new information arrives. Contingent claim models account for this reality, proving that in highly unpredictable environments, operational flexibility carries a quantifiable financial value. To see how these frameworks behave under real market pressure, we can look at mergers and acquisitions or private transactions like the sale of premier sports franchises. The core mathematical challenge in an acquisition is clear. How does a bidding firm justify offering a massive premium above the target's current market price? This waterfall chart shows an acquisition bid is a layered construct. The foundation is the status quo valuation, the exact worth of the firm today. The second layer is the value of control, the financial gain from removing incumbent management. The top layer is the value of synergy, isolating the upside of combining both firms, culminating in a dotted line representing the maximum bid price. You only justify a massive acquisition premium by strictly isolating the exact value of control and synergy. Valuation requires aligning the mathematical tools at your disposal with the specific asset sitting on your desk. This decision tree maps the deterministic flow of model selection. Every valuation starts here, dictated by the asset's underlying characteristics. If the asset produces predictable, steady cash flows, you follow the top branch and build a discounted cash flow model. If the cash flows are erratic, but the broader market provides highly comparable peers, you follow the middle branch to relative valuation. If the asset operates in total uncertainty, yet possesses embedded management flexibility, you route to the bottom branch for contingent claim valuation. Spending countless hours tweaking a complex spreadsheet yields nothing if you chose the wrong branch of the decision tree. Do not calculate the math until you have mastered the fundamental architecture of the